Welcome to the Deep Dive. Today we're cutting through the noise to bring you the essential insights from Mattel's second quarter 2025 financial results. And of course, the earnings call that followed.
That's right. Our goal, as always, is to distill what really matters for you, the experienced investor. It's about understanding the why behind the numbers.
Exactly. Because knowing why things happened is crucial for positioning.
You're right.
Especially in this market.
Absolutely. Looking beyond the headlines, understanding the strategy, the nuances, that's where the edge is.
Okay, so let's jump right into Mattel's Q2 results. And it was definitely, you could say, a mixed picture.
That's a good way to put it.
The headline number, net sales, saw a 6% decline. That's both as reported and in constant currency, landing at $1.02 billion.
Right, a top-line dip, but, and this is really interesting, despite that sales decline, they actually expanded their adjusted gross margin significantly.
By how much?
A full 200 basis points. It hit 51.2%.
Wow, okay. So sales down, but profitability per sale, or at least gross profitability, is up.
Yeah.
That tells a story.
It does. It signals a strong focus on, well, managing costs and efficiency, even when sales are tougher.
Okay, what else? Adjusted operating income.
That decreased slightly by $8 million down to $88 million. And adjusted earnings per share that stayed flat year over year at 82.
Flat EPS, okay. And gross billings.
Total gross billings were down 4% in constant currency, so generally softer on the top-line metrics.
But you mentioned efficiency. What about the balance sheet? Any moves there?
Yes, definitely some strengthening happening there. They bought back $50 million in shares this quarter.
$50 million.
Which brings the year-to-date total to $210 million. So they're, firmly on track for that big $600 million full-year target they set.
That's a pretty significant return to shareholders.
It is. And their cash position improved too, up $148 million compared to last year, sitting at $870 million now.
Solid cash balance. And debt.
Leverage is looking better. The debt-to-adjusted EBITDA ratio improved to 2.2 times.
So pulling it together, softer sales, yes, but improved gross margins, flat EPS, and a stronger balance sheet with significant share buybacks.
Exactly. It shows, I think, a real focus on financial discipline, even while navigating those sales challenges. That's important context.
Absolutely. So that's the snapshot. Now let's peel back the layers a bit. That contrast between the U.S. and international business seems key.
It really is.
The overall net sales decline was largely, they said, driven by challenges here in the U.S., things like global trade dynamics, but also these shifts in how retailers are ordering.
The direct import versus domestic shipping chain.
Right. Can you unpack that a little? What does that shift really mean for Mattel's reported numbers?
Sure. So think of it like this. Direct import is when a big retailer, say Walmart or Target, orders a massive container load directly from Mattel's factory overseas. The sale gets booked pretty much when it leaves the factory port.
Okay, got it.
Domestic shipping means the retailer is ordering smaller amounts, more frequently, from Mattel's warehouses already inside the U.S. The sale gets booked later in the process when it ships from that U.S. warehouse.
Ah, so if retailers shift from big, early direct import orders to smaller, later domestic orders.
Exactly. It creates a timing lag in when the revenue gets recognized on Mattel's books. It can make sales look lower in a specific quarter, even if the final consumer demand hasn't really changed that much. It's more about retailer inventory strategy.
That makes sense. So it's less about people suddenly not wanting Mattel toys and more about logistical shifts by the big retailers.
That seems to be a major part of the U.S. story this quarter, yes.
And the contrast is stark because while the U.S. was facing that, international growth was actually really strong. Gross billings up 9%.
Yeah, quite robust. And it wasn't just one region carrying the load.
No.
EMEA, that's Europe, Middle East, Africa up 8%, Latin America up 5%, and Asia Pacific was the real star, up 16%.
16% in APAC. Wow.
That geographic diversification is clearly paying off. It provides a buffer when one market, like the U.S. this quarter, hits a bump.
And here's another piece of that puzzle. Despite the U.S. reported sales dip and the shipping stuff, their point-of-sale data, the actual checkout scans.
U.S. data, yeah.
That was positive. Low single digits up globally for both Q2 and the first half. What does that tell you?
That's crucial. POS data is the closest read we get on actual consumer demand, what people are really buying. The fact it's positive, even low single digits, while reported sales are down. It strongly supports the idea that the Q2 issue was primarily about that retailer ordering timing and the shipping shift, not a fundamental drop in consumer appetite for their brands. The underlying pulse is still healthy.
Okay, so demand seems solid. The timing will hopefully sort itself out. Let's talk about that margin expansion again, that 200 basis points. How'd they do it?
Well, a big driver was their cost savings program, the one they call optimizing for profitable growth.
Right, they didn't talk about that for a while.
And it seems to be delivering. They generated $23 million in savings just in Q2.
23 million, not bad.
And since they launched it back in 2024, it's already delivered $126 million. They're on track for their $80 million target this year and the total goal of $200 million by 2026.
So this isn't just a one-off cost cut, it's a sustained efficiency drive.
Seems like it. Plus, they mentioned lower inventory management costs and general supply chain efficiencies helping out too. It shows a real operational discipline, I think.
Good. Okay, let's dive into the specific product categories because there were some pretty big swings there. Dolls, down 19%. Ouch.
Yeah, that's a big number, but you have to remember the context.
The Barbie movie effect last year.
Exactly. Last year was just phenomenal for Barbie because of the movie's halo effect. Promotions, demand, everything was through the roof. This year is inevitably going to be a tough comparison.
So it's more about lapping an impossible comp than Barbie suddenly falling out of favor.
Yeah, I think that's largely it. Management sounded confident about the brand's global strength. They also mentioned fewer new product launches this Q2 compared to last year, and that direct import shift hit dolls too. But fundamentally, Barbie is still Barbie.
Okay, that makes sense. Now contrast that with vehicles. A completely different story. Up 10%, double-digit growth.
Yeah, Hot Wheels continues to be just relentless.
Relentless is a good word. Hot Wheels itself up 9%, poised for its 8th straight year of growth.
Incredible, isn't it? Driven by the core die-cast cars, but also tracks and playsets.
What makes Hot Wheels so consistently strong, do you think?
It's accommodation, probably. The affordable price point is huge. It's an easy pickup, an impulse buy. Plus, the collectability factor, the constant stream of new designs, the appeal across different ages.
It just works.
It really does. It's a high-volume, high-margin bedrock for them. Shows the power of those core classic brands when they're managed well.
Okay, then the other end of the spectrum again. Infant, toddler, and preschool, down 25%. That's mainly Fisher-Price weakness, right?
Yes, primarily Fisher-Price, plus they're exiting some planned product lines in that segment too.
And Fisher-Price got hit particularly hard in the U.S.
Disproportionately so, down 33% in North America versus only down 2% internationally.
Wow, 33% versus 2%. That really points back to those U.S.-specific issues, the trade uncertainty and retailer shifts you mentioned.
It does. Fisher-Price items tend to be bulkier, maybe more reliant on direct import historically, so they likely felt that disruption more keenly than, say, small Hot Wheels cars.
Are they expecting a recovery there?
They are. They expect improvement in the back half driven by new innovations hitting shelves for the holiday season and hopefully more normalized retailer ordering.
Okay. And rounding out the categories, the Challenger Group.
That was a bright spot. Up 16%.
What's in there?
Mostly action figures doing well. Think Jurassic World, Minecraft, WWE licenses. Also games, specifically Uno, continues to grow.
Uno's having a moment, isn't it? With things like the Uno Social Club.
Yeah, they're doing a good job keeping it culturally relevant, expanding beyond just the card game. It shows they can find growth pockets beyond the absolute biggest brands. Good diversification.
So looking ahead, they brought back their full year guidance for 2025, which is a positive sign.
Yeah.
It's the outlook.
Right. Guidance is back, and it incorporates the known impact of announced tariffs. They expect net sales to grow 1.3% in constant currency for the full year.
Okay, 1.3%. That's a slight tweak downwards from the previous 2-3% range they hinted at earlier.
It is. They attributed that slight revision mainly to just broader macroeconomic uncertainty, not a specific worsening within Mattel itself.
Got it. And margins.
Adjusted gross margin expected around 50%. Adjusted operating income between $700 and $750 million.
Solid numbers. EPS.
Adjusted EPS targeted between $1.54 and $1.66.
And free cash flow. I thought I saw a bigger change there.
You did. Free cash flow guidance is now approximately $500 million. That's down from the $600 million they previously expected.
Why the $100 million drop in free cash flow?
Primarily due to working capital timing effects related to navigating the tariffs. So think inventory builds or changes in payment cycles as they adjust sourcing. It's presented more as a timing issue within the year rather than cash disappearing permanently.
Okay, tariffs. Let's talk about that. It sounds like they're managing it better than initially feared.
It seems so. Their estimated exposure for the year before mitigation is now less than $100 million. That's quite a bit lower than an estimate they gave back in Q1.
And they have mitigation plans.
Oh, yeah. Accelerating supply chain diversification, moving production around, optimizing where they source components, taking some pricing where needed, and continuing those cost-saving programs we talked about.
That supply chain flexibility sounds like a real asset right now.
Absolutely. Being able to shift production or sourcing quickly is a major competitive advantage in this environment. It helps them absorb some costs, maintain pricing discipline, and keep products flowing. It's crucial.
What about the consumer side? Is demand holding up? Are prices going up?
Well, the overall toy industry seems healthy. Grew year-to-date through June, expected to keep growing. Toys were actually the fastest growing category tracked by Circana across 6 industries.
Interesting. People still prioritizing toys.
Seems like it. Mattel did take some necessary pricing actions in the U.S. earlier, but they said they don't anticipate more increases this year. They really emphasized their broad portfolio,
Oh, so
pointing out that something like 40–50% of their products are priced below $20. So they have affordability built in, which helps buffer against consumer spending pressure.
smart. Balancing cost recovery with value.
Exactly. It's a nuanced approach.
Now, we absolutely have to talk about the entertainment strategy and AI. This feels like a major shift.
It is potentially transformative. Mattel Studios is formed, aiming for 1–2 films a year starting 2026.
1 to 2 films a year. That's ambitious.
Very. And they have stuff in the pipeline already. Masters of the Universe, Matchbox are in post-production. Big partnerships announced too.
Like what?
Illumination, the Minions people doing a Barbie animated film. John M. Chu directing a live-action Hot Wheels movie. New digital game deals with Netflix. It's a serious push into content creation.
Is this Mattel trying to be Disney? Are we looking at a toy company morphing into an IP powerhouse?
That's the narrative, and honestly, it's becoming more credible. It's not just about selling toys related to a movie anymore. It's about creating the content, owning the IP, driving the cultural conversation, and benefiting across the entire ecosystem: films, streaming, games, and toys. It could fundamentally change how the market values them.
If they execute well.
If they execute well, that's the key. But the ambition is clear.
And then there's the OpenAI collaboration. Using AI for new forms of play. What does that even mean?
Well, details are sparse, but it signals they're thinking beyond physical toys and movies.
Yeah.
How can AI enhance play, create interactive experiences, personalize digital content? It's very forward-looking. It positions them at that intersection of physical, digital, and now AI-driven entertainment. It's about future-proofing their IP.
Fascinating stuff. Okay, let's quickly touch on the analyst Q&A takeaways. Anything to jump out?
Management really hammered home that the revised guidance, the slightly lower sales outlook, was more about macro uncertainty and tariff flow-through, not some internal breakdown.
So external factors, mostly.
Right. They also reiterated that the Q2 disruption from retailer ordering and the domestic shipping shift is seen largely as a timing issue. They expect to recapture most of that in the second half as things normalize.
And they sounded confident about managing pricing without killing demand.
Yes, leveraging that broad portfolio and being strategic, not just raising prices everywhere. They also highlighted again that supply chain flexibility as a key advantage versus peers in managing tariff impacts.
What about the outlook for the rest of the year, category-wise?
They see continued strength in Hot Wheels, action figures, games, and they expect improvement in Barbie and Fisher-Price performance in the back half, thanks to new products and better distribution. Plus, the overall toy industry momentum helps, and retailers see toys as a key category.
So, cautious optimism, grounded in operational strength and brand power.
That seems to be the message. Navigate the near-term challenges while executing the long-term transformation.
All right, that brings us nicely to our This Is Not Financial Advice segment. Time for an outrageous but plausible play.
Okay, let's tee this up. And remember, everyone, this is purely for discussion, for stretching the thinking, definitely not investment advice.
Got it. So the idea for Mattel, consider a long position.
Okay.
The bet is on the massive, but currently, we think, undervalued potential of their IP transformation, way beyond just selling toys.
Right, the entertainment pivot we discussed.
Exactly. The outrageous part is believing the market is severely underpricing Mattel's shift towards becoming a major content house. You know, the Hot Wheels movie, Masters of the Universe, the Illumination deal for Barbie, that OpenAI collab.
Yeah.
This is potentially just the start of a huge IP monetization wave.
Okay, so the outrageous part is the scale of the potential upside if they nail the content strategy. What's the plausible part that grounds it?
The plausible angle is that the core toy business, especially those powerhouses like Hot Wheels and the action figures, is still really strong and profitable. It provides a solid foundation, good cash flow, while this bigger entertainment strategy plays out.
So the existing business provides the floor, the IP content strategy provides the potentially huge ceiling.
Precisely. It really hinges on them delivering on that 1-2 films per year goal starting in 2026. If those films hit, even moderately well.
The company could see a significant re-rating, moving from being valued like a cyclical toy maker to something closer to a diversified entertainment and IP company.
That's the thesis. The market, arguably, hasn't fully bought into that transformation story yet, creating the opportunity. The Q2 dip, driven by temporary U.S. issues, might obscure this bigger picture.
It's definitely a long-term view, betting on strategic execution. Outrageous. Maybe in its conviction. Plausible. Given the steps they're taking, yes, interesting idea.
So, wrapping up our deep dive today, Mattel in Q2 showed, I think, real operational skill. They navigated a tough U.S. market, grew strongly internationally, and expanded gross margins meaningfully.
Yeah, that operational excellence stood out. And they're clearly pushing forward hard on the entertainment side, leveraging tech like AI, while still keeping the balance sheet strong and returning cash to shareholders via buybacks.
They seem confident in their brands, their discipline, and their strategy, despite the obvious macroeconomic headwinds out there.
Agreed. They're managing the present while building, potentially, a very different future.
Which leaves us with a final thought. As Mattel keeps blurring the lines between physical toys, digital games, AI-enhanced play, and big-screen movies, how could this IP-first strategy reshape the investment case? Not just for Mattel, but maybe for other consumer brands sitting on dormant IP.
That's a great question. Could we see more companies trying to unlock latent value in their brands through content? It's definitely something to chew on as you continue your own deep dive.